Hello, Jeff Green here, and I just want to produce a short video about interest rates. I've been getting a lot of calls this week about why interest rates went up, a little bit about interest rate volatility, and when they might come down. These interest rates have been just bouncing around all over the place for the last couple of weeks. So I'm going to try and answer these questions for you. So let's jump into the next slide. This is a slide of, let me get a pointer over here, of Jerome Powell's fight against inflation. Jerome Powell, chairman of the Fed, has clearly advertised that his goal is to focus on 2% inflation as the Fed promises an unconditional fight. His unconditional fight is costing you and me in interest rates, but you can make certain claims about the Fed actions, but that's what's happening. So there's that 2% annual inflation based on this measure. And we're going to talk a little bit about when I think that might be reached, sometime between April and May 2023, which means that we might see a tapering off of interest rates, but we'll have to wait and see. So the way this works is these are the current 4 readings of inflation rates in the U.S. economy. Now what they do is they measure back 12 months. So this 9.1% goes back 12 months. That's this line. There's 8.5%. That's this line. Excuse my crooked lines. That's the way it's going to be this morning, I guess. And then the most recent, maybe 7.2% in the next month here. So when you compare these going back, you have to remember these are annual inflation rates. So the most recent reading was 8.2%. So let me clear all this stuff, and I think it might make a little bit sense to you. So you see this area here. So they've been relatively flat, right? So the increase, from these levels here have not been very high. They've been between 9.1 and 8.2%. So that's right within Jerome's 2% inflation. So if prices remain at this level, let's say for the next 12 months, or let's say 4 months here of flat rates, we need another 8 months to compare this reading to. Let's say it stays around 9%. That would be measured against 12 months later, which is right when it started to flatten out. So if you use this analysis, you might expect Jerome Powell to have reached his 2% goal around this time here, April or May, June of 2023. So that's where this number comes from here. If we can just manage to hold prices at this level, the difference on an annual basis will drop down to 2%, which, as we've talked about a couple of times, that's Jerome Powell's, that's his focus. So what we're going to have to do is sort of track this all through the next 8 months here and see what happens. Let me move my mug out of the way here. And you can go to this link and sort of see these inflation rates and what that might bring forward. So that's where we are on why those interest rates went up, trying to slow down the economy to reach that 2%. Now the next chart here shows you a little bit about how volatile these rates have been. I have next slide is a longer term chart which sort of evens out this, but you can see here it has just been over, since right in here January. It's just been a ridiculous acceleration in interest rates. There goes my rotten line again. But you see what's happening here. We got a bounce up in early June to 6.3, then it bounced down to 5%. So if you were a buyer looking to lock in a loan, 5% would have been a good rate to lock in on. And if you have a 2-to-1 buy down with seller concessions, that would have got you down to the 4, maybe 3% range, which is a very competitive interest rate. You see they went back up from 5% to 6%, and then they jerked up here again from 6% to 7% in September. So we don't have a final read on October final month, but we're looking maybe at 7.12%. That's higher than it has been for the last 2 or 3 decades, but it's right around the 30-year average. So this is a pretty interesting cartoon. When a fisherman's out and he gets a little bite, you want to set that hook and lock in that rate. So if you see this volatility and you're looking to buy a house, you got to be ready to buy in that rate, because I believe that if you're looking back on the prior chart, let me get that prior chart out back again. Clear those. If you get that prior chart back, it might be April or May, you might only have 3 or 4 months or maybe a year before you can refinance at lower levels. So what you want to do is you want to date the rate, but marry the price on a new home. So let's look at the last, the other thing is here up here. You can go to this website here and find recent news on mortgage rates. So let's go to the last slide here, and this will be kind of enlightening. This is the historical interest rates over the last, since 1973, right? That's a long time. You can see that it starts right here at 5%. And unbelievably, we were getting mortgage rates up here in the, above 15%. I remember, because I'm older than most people, but I can remember mortgage interest rates being, 16, 17%. It was kind of a dilemma. Now, I bought my first house, let's see, it was in the early 80s. So when I bought my first house, it was in here. So the way I look at buying a house is not whether the interest rates are going up or down or prices are going up or down. I remember quite clearly I was paying about $1,500 for rent at the time. I was sharing it, so maybe I was paying half that, so let's say $750. So even at this 10% rate, I could get into my first house at about, with a payment of about, if I remember correctly, it was like $500 or $550. So the direction of interest rates I didn't care about that. And I didn't care about house prices moving up or moving down. All I cared about was that I could get into my own house, start building equity, and pay less than my rent. And it actually worked out fairly well. I think I bought my first house for, I think, $55,000, which was a tiny house. But I sold it 2 years later for somewhere around $80,000. 2 years, right? And in that time, interest rates had dropped, I don't know, maybe 2 or 3%. So I think you need to less worry about the actual value of interest rates and worry about what sort of payment you're making. Because remember, when you're paying rent, it's 100% loss. You're paying the landlord's mortgage, and all your payments essentially going straight into the garbage as far as your equity or financial future is concerned. So since the 80s, we had a slowly decreasing interest rate. That's a better line, and it's better than before. The other thing that's interesting in this analysis is these gray spots are recessions. Now you can make a debate about when or who calls recessions, but you can see that when recessions happen, interest rates fall. Recession here, interest rates fall. Recession here, interest rates fall. Recession here, interest rates fall. Okay, so what do we expect? Everybody has expectations for a recession in the next 5 to 6 months. And as a matter of fact, if you subscribe to my channel, I'm going to post another video on what's called the negative yield curve, which we're in right now. That's been very dependable on predicting each one of these recessions. So let's suppose we have a recession out here somewhere, right? What can you expect interest rates to do? Well, over time, they'll sort of fall off a little bit because the market, the economy's slowing, and Powell will want to lower interest rates, presumably when inflation cools also, to pick the economy up. So this is when I would expect interest rates to start falling. If you remember from the prior chart, let me get my pointer back. The prior chart was, let's see, back here, late spring to early summer next year. So I think you need to keep that in mind if you're looking to buy a house in this environment. There are starting to be some very interesting prices. There's a lot of seller concessions. You could get a 2-to-1 buy down. You could use maybe $10,000 or $15,000 to buy your mortgage down, which would get you into a very reasonable payment. So you can go to these websites here. Let me move my face out of the way here. You can go to Freddie Mac and get this chart. And again, subscribe, and I'm going to post a video on the negative yield curve, which is kind of indicative of future recessions. So that's it for mortgage interest rates and what's happening and what we expect in the future. If you have additional questions, you can contact me here. Let me show you where I am here. You can call me direct, voice or text on that number. You can email right there, And you can go online and get all this information whenever you'd like to. So I hope that helps. I hope you have a great day, and we'll chat with you later. Bye-bye.